This is Lowell Walters, and welcome to part 4 of my executive benefits compensation series on rewarding employees you cannot afford to lose. I'm an attorney at Carlton Fields, and the focus of my practice is employee benefits. Now, in part 1, we talked about how you can decide whether an executive benefits program is right for your company and ran through a list of what you can do to reward a few higher ranking employees. In part 2, we talked about which employees should be included in an executive benefits program. And in part 3, we took a look at the simpler options in more detail: regular pay, bonuses, deferred compensation, and two types of arrangement that have stock in the name but actually are cash benefits: restricted stock units, phantom stock awards, and stock appreciation rights. If you happen to skip part 3 because you wanted to focus on stock arrangements, you might want to go back to the second half of the part 3 video. Now, in this video, part 4, we're going to look at common stock arrangements. And keep in mind that I'm using the term stock. In general, these benefits can be used with LLC membership interests and other ownership structures. Now, actually, as an added benefit, if you do have a different structure or you have an entity with different classes of stock, like LLCs often have capital interests and profits interests, your organization can choose what you're going to offer your employees in these stock arrangements. All right. Now, I'm not so much going to focus on pros and cons. These are more complicated. You do need legal and tax advice. I'm really just going to focus on the key aspects of the different types of stock arrangements. And for all these, actually, just to be clear, not only should you have tax advice and get someone knowledgeable drafting your options properly, but you should probably get corporate advice too, because at the end of the day, you might have future new shareholders. So, stock option plans. Stock options allow a select group of employees who meet certain goals to purchase employer stock. So it is clearly an easily understood ownership opportunity. All right. In general, the price of the stock is set at the outset. This might be a program that if they meet certain incentives, they earn the right to buy stock in 4 years. And so the stock is set now. If in 4 years the stock has increased, the employees get a deal. If the stock decreases, those options really lose their value, right? If they have the right to purchase stock at $300 a share, and at the time they're able to purchase it, the stock is valued at $200 a share, they're not going to exercise those options. So it really does closely tie the employees' benefits into the health of the company. In general, the value that they pay for the stock, or actually the value of the stock on the exercise date minus the amount paid, is subject to ordinary income tax. So if the arrangement is set up where they're going to pay $300 per share, and then when the time they exercise that right, the stock is valued at $500 a share, 5 minus 3 is 2, there's going to be $200 a share of taxable income there. Potentially, there is something called a statutory stock option that can avoid that income tax. There are certain additional restrictions that sometimes employees don't like, and you can go into that with your advisor to see which one is right for you, statutory or non-statutory. Another nice aspect is clearly these provide a penalty or a forfeiture opportunity for employees that don't satisfy the criteria. If they leave before they're eligible to purchase the stock, they don't get to purchase the stock. End of story. And these are not recurring benefits. You might roll out one stock incentive plan, and they have a right to purchase so many shares if they're with the company for so many years. The end. If you decide to issue a new round of stock benefits, that's a separate issue. This is not a continuing benefit, which can be a nice positive. All right. Very often, a key issue with stock option arrangements is how you expect your employees to exercise the options they've earned. Will they have the cash to buy the stock? Now, usually these are higher ranking employees, and maybe their salaries are high enough that the expectation is they are saving money to buy the stock, and that is fine. That is fine. But what about if you have a startup organization and you're using this as an incentive to keep employees without increasing their pay? All right. Are you going to let them borrow money from the company? Can they borrow money from the company? One option that's commonly used is allowing these employees to sell some of their options to the company in exchange for cash to buy the remaining options. Just as an example, let's say if someone meets their incentives, they become entitled to buy 500 shares of the company. Regardless of what the price is per share, if they're allowed to buy 500 shares, then presumably they could sell 250 shares to the company and get enough money to buy the other 250 shares. And normally that would be done. That would actually be a cashless transaction. They're in essence, the company is buying their option rights and forfeiting half their options, and they use that cash to buy the other stock. So there certainly are ways around it, but that is a key consideration. And actually, because of that issue, a lot of companies use restricted stock programs. In a restricted stock program, select employees are given the stock, but they forfeit it back to the company if they fail to meet certain incentives. Usually it's a length of employment incentive. The participants are given the stock. They do not pay for it. They still have a financial incentive for the stock to increase in value, but they still benefit even if the stock value decreases. There is the forfeiture opportunity if the employee doesn't stick around long enough or meet other goals. And once all goals have been met and the stock is no longer restricted, maybe they have restricted stock for 5 years, and after 5 years, it's theirs outright. Well, at that time, ordinary income tax is due on the value of the stock. Now, there is something under Code Section 89. If there really is an expectation of there being a significant rise in the stock value, the employee can elect to pay the tax early. All right. Now, if you're a startup organization, the value of the company might be zero, so they can make this election, actually pay zero tax. Or if it's an ongoing company, maybe they pay tax on the value of the shares at $50 a share, and then at the time the restrictions lapsed, regardless of what the value is, they're not paying any more taxes again. So if they paid it on $50 a share and the stock value shoots up to $500 a share, they still don't have to pay any more taxes than what they paid at this point early on. Now, of course, there is risk for the employees in doing that. They don't get their money back if they ultimately forfeit the stock, or they don't get their money back if the stock value actually decreases. With all of these arrangements that I've mentioned, all of these stock-based arrangements, fair market value is very important. All right. Unlike a bonus that is tied to a sales goal, these stock-based arrangements do require knowledge of a stock's fair market value. And this can be ambiguous when a stock is not traded on an open market. All right. Now, certainly you can pay for a valuation, and there may be circumstances where that is entirely appropriate and reasonable. Most of the ones that I see, they use a reasonable formula, often based on EBITDA, earnings before interest, taxes, depreciation, and amortization. In general, you want to use a reasonable formula and then use that formula consistently. All right, that's really the key to having fair market value. So now you know a few details about how you can provide your more important employees with an incentive of stock ownership or company ownership, organization ownership. In the next and last installment of this series, you'll learn how you can reward a small subset of your employees with welfare benefits. If you have any questions or comments about this video, please share them. And for more information, you can visit carltonfields.com or email me at lwalters@carltonfields.com. And don't hesitate to contact me with general benefits questions or with suggestions for future videos. Thank you.